Morning, team. Lord Sith Planty here of the Alpha Capital Group Alliance. Welcome to my new trading zone. So here we are. Yeah, we're back. The room's been rearranged. We've got a whiteboard in the background. We're going to be doing quite a bit of teaching on that. Loads of cameras. You're going to get me from both angles. You can see the kit there behind me. But on with this week's preview, 25th of the 3rd, 24. And what happened last week? It was all about those 5 central bank meetings, and we nearly forgot the Swiss when we were counting them up, and they actually were the ones that put in the surprise cut. So you can never be too careful. Always check exactly what's coming out. This week is probably going to be quite dull. It's the end of, well, it might not be dull, but it's going to be shortened and might be lacking in liquidity. It's the end of the month and it's the end of the quarter, and it goes into Easter holidays. So we're in the final week of the time difference between the US session and the UK time. That will equalize again from Sunday the 31st. So this week, remember, we've got Good Friday where just about everything is closed, apart from the maniacs like yourselves that trade Forex. US opens properly again, along with commodities on Monday, and Europe catches up with the rest of the world having an extra couple of bank holidays. So we have Good Friday and Easter Monday. So it's going to be truncated. You have to double check exactly what's open, and good luck with that. So, yeah, there's not a lot of data particularly either coming through. PCE actually happens when the market's closed on Friday. We'll get obviously a Forex reaction, but the read through, and I don't imagine there'll be many talking heads on the back of that either until we get into the following week. Outside that, we've got the Michael Jordan durable goods special. You'll all be all over that this time. Final US GDP for the US and the UK on Thursday. There'll be Japanese retail sales. We're hoping that has a little rebound of confidence, given the fact it was well publicised what the wage negotiations are going to be. So what else is happening out there? There's a chart involved I've got in the pack there. The US 2-year, 10-year inversion. It's now even more than it shows there, probably 428, I think it should be up to. The longest spell of an inverted yield curve. And remember, they normally lead to a recession. The argument now is whether the slowdown was the effective recession, and the fact you're only getting a real tech breakout. Everything else has been sat on its knees. So I'm sure somebody will concoct a reason going forward to say that we really had it. A lot of chatter throughout last week outside the central banks talking about the Fed balance sheet coming down to by $1.5 trillion. I look at it the other way around and look how much money is there to come out of money market funds, up 6 to 8 trillion we've been talking about, and there's already evidence that is going down that yield curve, longer maturities, longer time to expiry, and down the risk curve. So everything's based off the national government treasuries of whatever country you're in, and then there's a risk premium added onto the yield, literally relative to how risky you are, and those yields are trading at pretty much on the record lows. We showed that high yield curve chart last week, but I think it's the fact that people are hunting down the yield rather than it being an example of exuberance. It's completely logical. If you think rates are going to be cut, you go and search for the highest yield you can find over that period, and that's what's going on. So we had the Bank of Japan, well flagged, great communication through the week, went into the actual announcement. They took the yield curve controls off, but academic that UADA is failed to immediately deliver what the market wanted, which was a path to further rate cuts, confidence to buy into the yen, blah, blah. So I think what you've got now is the fact they've said they ultimately wanted to be still in an easing mode. The market's going to push against the line of least resistance, which water doesn't trickle up a hill, it floods down, doesn't it? So they're all having a go at the yen, the currency. The JGBs, they've already said that they will back their own bonds. They already own 60% of the issuance. There's not that much scope for the hedge fund to take that on at the moment. There's probably got confidence in that, but the yen, it's open season. So let's push them and see how far it would take before further intervention was required. Something that the market tries. It's very much speculative, and it's getting in the way of what should be in the medium term, a rally in the yen. We had indices effect, the stock effect in the Japanese stock markets, totally buying into this inflation narrative and escape clause, and the very fact that the yen weakened as well has remained a boost for the exporting sector. So from Ueda's perspective, it was a win-win, but he has now come out on Thursday and pushed back a little and saying that he thinks that the inflation rate is hopefully going to be strong enough to get this further rate cycle going forward. So they're obviously knowing they need to do a little bit more work on the rhetoric to defend the yen. Royal Bank of Australia didn't really do much, still saying that it's a hard fight that hasn't been won yet. And then we had obviously the daddy boy on Wednesday, the FOMC. I thought Powell handled the conference fantastically well, defending it both ways, following the data, doesn't want to do anything to disturb the employment side of things. So the narrative that's come out of that is that they'll accept a bit of inflation for longer, but not at the cost of bringing the economy down. I've said for weeks that it's a fragile thing, this, and it could really implode at any moment. So you don't really need to be leaning on the markets with high interest rates. So there is a bias for across the globe to get some ballast back into the system, give you a chance to move, keep things chugging along. And there's big evidence that people are working fewer hours. So, with the fact that there is wage inflation is slowing, and you've still got some sticky inflation, that's not necessarily going to see things run away. People are going to start rebuilding their savings, I would imagine. So a little less pressure. Unfortunately, the bond market is in a bad mood. Didn't really enjoy the way that Powell was so open and not really worried about the blips in headline inflation. I mean, I don't mind, but they have been saying for months that they follow rents, they follow PCE. The PCE's got lots of moving parts. We're all over that. The ones that have caused issues pulled back a little bit last month. Rents has been the massive thing. It's a third of the weight of CPI. It's been sticky because the way it's constructed, it takes 6 months of rent reviews, whereas real-time rents are going through the floor. The Fed are cognizant of that, and he was saying absolutely adamant that rents are going to come down. So therefore, he's leaning towards 3 rate cuts still. It's not rocket science, but I don't know why people are churlishly taking it on. It's causing a few issues with the dollar into month end. I think with this quiet period we've got for 4 days, be careful, very choppy, very volatile. People probably cashing in the big bets, maybe preparing for next quarter, but possibly won't go until April. What will it be? April the 1st, actually. I think next Monday, isn't it? So look out for crazy trades in the morning session when that happens. So then we went into the Swiss bank, and they surprised that they were the other side of all this. They were importing disinflation, and their currency was a little bit too strong as well. So they'd flagged. Most people hadn't even had it on the radar as there being any chance of anything happening, myself included. Totally ignored it, and there they were, bang on top of it. The Swiss do have a long-held reputation for playing around with their currency when it gets too strong, so we shouldn't have been surprised. And the Bank of England, the data came in. It's been pretty supportive. CPI, not a massive beat, but it was a beat in the right direction, and we got the surprise we wanted on the back of the FOMC and Japan saying they're accommodative, Swiss bank being accommodative. The Bank of England, the two people that were still in the rate hiking camp, Haskell and Mann, both came back to the pack. So it was an 8-1 for holding and even a cut put forward. So, yeah, the talking head Bailey response to all that was that we're very much in the forthcoming meetings in a mode disposed to talk about cutting rates. So he's not, and he also said he's happy with the yield curve purporting that there would be rates. That's got 3 priced in, and he's happy with that. So, we're back on track with the US 3, UK 3, and quite possibly the EU being the one most likely to do the sequential cuts, and probably 4 by the end of the year is what the periphery wants, particularly the Greek governor keeps going on about it. So yeah, outside that, we had the move, the dollar weakness move straight away from the FOMC, but the bond market didn't go with it. So we've since had this dollar retracement, which has put everything back into little consolidation modes. The growth rhetoric for indices ignored it though, and we're putting new highs in the US markets into the end of the week. The Footsie is well on the way to a sort of foot dragging, kicking and screaming rally. It looks like a consolidation leg to new highs, which we've been hoping for, and we'll flash the chart up later to show you that. Gold again, another high. I do think we're in the other side of that nesting we've been talking about, the 3-4-5s. That was a 3 by the look of it that was put in on Wednesday night. We're now into a consolidation 4 before we put in another 5. And then these things cascade with an upward bias, loads of 3-4-5s until the whole thing eventually tops out, which by the look of it is going to be somewhere around $2,500. Let's hope that is the case, but there's going to be opportunities within that. And because of the magnitude of the potential buys, I don't advise necessarily taking it on as a seller apart from when it's at the extremes. Generally, my analysis would say look to buy this into weakness, into 3-wave pullbacks, and towards the end of the 3rd wave. And we'll keep you up to date when I think those are. I mean, you can do your own analysis. There's lots of order blocks in the way, quite obvious support zones. So by all means, play it in the short time frame, but be massively aware of the volatility. So other little highlights that came out of last week on the stock side, we had Tencent, the Chinese online music super stock, and that actually beat on its subscription basis, but its numbers are down because the Chinese government had clamped down on their subsidiary earnings with the effectively gaming and betting side of things effectively. So that had a little pullback. Nvidia was the big story of the week. They had their conference for the era of AI with Jensen Huang, the CEO, really struggling to contain his excitement, as you'd expect. And with all this, lots of quotes around in the media post that all about the Moore's law and where we are. And they were big to make it pains that they're growing at 1,000 times for a 10-year period and they're only 8 years into it. He's very much talking about a new infrastructure build, and it's getting all very sci-fi. It's token ready, new infrastructure coming. They need billions, 200 billions of chips just to set up the next big GPUs. So he's effectively saying we're at the foot of the mountain, and there's loads and loads of this to come. People, if you're trying to fade AI, look out, because generative AI. So certainly, I think he quoted it being, if you want to see something that's 8% more productive than a human, that's coming in the next 5 years. So that'd be a first start. This is all looking like we need Jeff Bridges to me. It's very much Tron Incorporated, isn't it? Before you know it, we'll be inside the game on those little racing cycles. Be very careful. But yeah, for now, the large cap tech is driving it, but the breadth is coming through. Equal weight indices in the States are all breaking out to new highs. Beware the doom monsters. This thing is now doing everything they said it needed to get some faith. So there's, again, we'll show a lot of these are in 3-4-5 grinding up formations, and the same for the Nikkei and the DAX. It's almost like a buy and hold model at the moment. Intel, Astera Labs, and Reddit both had IPOs this week, and they were both exploding to the upside. That's a slight caution. We've got the secondary and tertiary players all coming with new things, and everyone's buying the heck out of them. It can be a sign that the tech rally itself is moving away from the fundamental drivers that we are happy to follow. Apple, yet again, it's a bad apple at the moment, isn't it? The Department of Justice now having a go at it on antitrust grounds. Nike, again, they slipped on a poor outlook, had an 8% stumble. But next in the UK, the fashion and home furnishings superstar, that jumped 8% after results. They're very, very good at guiding a poster child, I'd describe them as, for guiding the market where it should go. They upgraded recently, and they went and beat those numbers as well. So not surprisingly, a nice 8% jump into Thursday and Friday's close. Very much online and getting rid of its sales stock inventories really boosting the numbers there. So that there's a little review of how things played out during the week. China started us off in a positive side. They just changed their mantra to being backing industrial production and specifics rather than building houses. And funny enough, the industrial numbers did beat, so that got everyone off to a positive start. We went through the Bank of Japan, and maybe right now we'll just have a quick look at the CME tool, because we went to great lengths to explain how that is working. Remember, in the middle of the week, not only did we talked about 55 being a pushback for the June rate cut, by midweek it had gone to almost 50-50. So some of what I'd said needed to happen started to. People were actually pushing back on what until that point had been a steady 55% for a June rate cut. Post the FOMC and into the end of the week, that's now jumped back up to 66.7, even a 50 bips getting priced back in 9%. So a good 75% chance of a June rate cut back up there. So, lots of volatility. And that is now at odds pretty much with slightly backing up yields on the US yield curve at the longer end, 10 years plus. So one of them is going to be right. They can both be right, particularly if you think that it is one or two at the most, which is what the bond market wants to try and tell you. So it's good that we have consensus coming back our way, and it's going to be supportive through Q2 that we're finally going to normalize some policy. Lagarde had a conversation on Wednesday as well. We mentioned it on the tweets, and pretty much as they going forward, they're going to release their own data block that they use for wages, and she spelled out exactly where they were. Still very much leaning towards June. She'd love to be able to go early, but can't. It was the net message there. Talked about everyone coming back for the Bank of England, and that did actually happen. And Micron gave another tech rally going into Thursday. A massive beat after hours, 18.8%. Jumped to the stock on a big beat to the revenue forecast. That got all the European techs going and put another kicker into the US indices for their strong finish into the end of the week. So, currency-wise, very difficult at the moment because we don't know where the U is going. Looks like it's putting in an extension to the consolidation pattern. It'd have to be a big move beyond the mid-year highs to change the pattern completely, but we've got lots of scope for taking out the January, February highs and extending into the 105, maybe 106 region if we're not careful. But there's every chance this is just all being caused by the end of the month, end of quarter flows, and just a little bit of indigestion of the news from the Fed on Wednesday night. So it's very much three for the Fed, 3 for the UK, and 4 for the EU. The EU most likely to have them quite close together. They're the ones that are in a bit of a mess. And then I list all the PMIs a little bit. There you go. Generally, a lot of manufacturing woes. France and Germany on the same day. Both, I think it was Thursday, wasn't it? Both fell, and below 45. There's only Germany, and that's when you're actually in a recession on these PMI surveys. So they had shown flickers of hope. This pretty much guarantees that there's going to be some help coming on the way. Services across the world all seem to be chugging along quite nicely. That's the message we've had. No real disasters there. And the US, again, more or less in line. US services ticking back, which is kind of in line with the surveys we'd had. We've got the new big boy ones, ISM, next week. And let's just hope that the prices paid are still pretty much behaving. And then all these consolidations can lead us into the next legs up. There you go, Macron. He always likes getting on the act, doesn't he? I love your Swiss rate cut. No, you, Wally. I said, I love you, Micron. So just have a read through. I mean, you should be aware of everything that had happened there. I just thought an interesting point that came out of that was I'd said before, we've got to be very careful about keeping rates too high, too long, squeezing any inflation out of the system. It's taken 15 years for the mega QE to even have an effect, and it took a war for that to happen, and supply side constraints. Therefore, the argument that you've got high rates doesn't make sense because they're all external geopolitical factors. So that's another reason why you should really risk trying to get some slightly higher inflation in that you have to bring down rather than squeezing the heck out of it. And the point I'm trying to make is China's in deflation. Japan is just on the verge of coming out of deflation and wanting to get inflation embedded into the system. Switzerland, again, slightly concerned that they were beginning to import disinflation. So, there's a predominant worry around the globe building that disinflation is just as much a threat as inflation, and it's either side of it's a double-edged, very sharp sword. So that's the reason why I think it's rational for the central banks to come out as sanguine and sort of accommodative as they were last week. Talking heads were pretty quiet last week. And the Fed had a little thing called the Fed Listens, a conference on Friday. Powell didn't have a lot to say, but what was being pushed there were people saying that they're struggling to keep up with their cost of living, and some evidence from some people from Orlando that rents really are starting to go through the floor. And it was quite interesting to see that Powell literally said, "Send us your slides." They're interested, they are wanting to listen, and this is very much part of their narrative that they mentioned on Wednesday. They're all over the rent pullback and can see how very quickly this is all could lead to some very big misses to the downside on inflation in months ahead. So we'll move on to charts. So pretty much as I was mentioning, the dollar here, we put in that high in the October 23, to which we thought we're now starting the 5-leg pullback. So put a C leg in before the dollar strength would re-engage, which we're expecting around mid-year. It's been putting in this 1-2 all the way along in this. We keep having a head fake that we're getting the nesting in the 1s and 2s. We thought we'd got the minor wave 1 in at the end of December. We've been retracing ever since. We keep threatening to roll over, and then having what we thought was a 2 in place in the middle of February. Very much looks like we're negating that. So as we look like we're nesting here, going into the Fed, and then we've got a proper move in the last couple of hours of session. Looks like that was it. The breakdown. We've been totally engulfed on Thursday, bringing in a bit more upside. So that means here that the 104.976 high for what was our minor wave 2 previous top. We'd like to see there's a potential for a spot 618 extension for the third leg here to just go into the 105 region. That would make that everything neatly, conveniently valid, and then see the sell-off start again at the start of next month when we think the seasonality comes in. What I wouldn't want to see is any more than equal legs, which would take us up to 106.717. It's still valid as a 1-2 deep retracement wave 2 nesting, blah blah blah, but it just opens up the danger that that could actually put a new high in, which would mean that previous B wave was extending, or what may have happened is that we'd finished off down here in December, and that we're actually, in the middle of an absolute 5-wave breakout. In fact, if we were to go, but there's even an argument that the July low could have been the end of an ABC third wave there, to which point we're actually tracing out a proper 5-wave upside already, because what we've got in here is a minor wave 1 down. That could be a 1 followed by a 2, and we're just nesting for a 3 breakout. That is an alternative bullish early scenario for the dollar. A lot of geopolitics and US election nonsense could easily put us into that new high territory if we're not careful going forward. And then we need that old friend, the dollar smile, to maybe come in, because with the fact that we've got proper growth in the background in the economy and the indices, it may well not be as dangerous as we're first imagining, because we've had this negative correlation going on with the dollar and commodities, etc. There is possibility that all might not be lost when that happens, because it could very much be a kind of risk on positive dollar, but we'll analyze that when it comes up. Now I've got my old mate gold coming up here. So a bit of a complicated looking chart on gold at the moment. Lots of colours on that. We were talking last week. The yellow fibs were looking at an equal waves within this third leg, and prior to that, we'd been looking at an equal waves, which could have taken us down to 21.36. As it was, the latter equal waves took precedence, and it bounced straight off that. We had a consolidation going into the Fed. The Fed took us up to the FOMC high, and that pretty much looks like we had the 1 or 2, the 3 to just prior, 5 to finish it off, and that put in pretty much a 5 waves for the minuet third wave that we'd been asking for. So we have got a number of 3, 4, 5 set up. So that means that we're in a consolidation 4 ever since, and that has been playing out with that Thursday engulfing pattern we had on the dollar. It's forced quite a bit of sell-off in gold, and we may already have put in a 1, 2, 3, a connector, and then another sort of 5 wave ending diagonal to finish here. We might already be nesting to the upside. What I'd really like to see, though, is this quiet period for the week. Do this in a proper fashion. Have that as the A wave, a B wave, and then we put in a 5 waves here, which either goes to a spot 618 extension or an equal legs back down here at 21.30. Either of those are valid. What all this essentially means is we're gearing up for a 5th wave breakout. Taking it on being a seller, you're going to have to be very nimble. Keep your stop losses tight. It's the old classic, but the bias for this market is still trending up. Make sure you're trying to buy it at the bottom of this trend channel, looking pretty much like it's marrying up with the fibs and the time frame for the week. So yeah, can't rule out a breakout, but that's the least likely without putting in a new low for the move since Wednesday night. Lots to play for. Thought this might be an interesting chart for you to look at. It's gold-silver ratio. And since the start of the year, the risk on has really been driven by gold. Of late, it's just that those highs of 108 relative are starting to come back. We've been back to 101.5. As of last week, that probably caught silver out a little bit with all the move over. Yeah, that was Wednesday, wasn't it? The move over the Fed. Actually, that was it. So yeah, as gold came off, silver has been catching up a little bit into the end of the week. So historically, silver used to be the real racy, positive market one. So you wouldn't rule out, more of a catch up and seeing this come back down to parity, and if not below down here. But either way, it's an interesting ratio to keep an eye on, and it very much looks like we have a trend channel to play the pair in. But at the moment, we're mid range and need to see which way it breaks. But yeah, something that has historically been a good money maker for lots of people. Good old Nasdaq, that has been playing like an absolute dream, hasn't it? And we've had that move up, Nvidia inspired, Micron inspired move up again last week, FOMC, you name it, they're all in there, they're all helping. Another new high on, when was that? On Thursday, that was post the Micron, 18,487 on the CFD. Putting in a little bit of a short-term pullback there, but it looks like we've got one more move to where we originally thought we'd see the end of this third wave. So I'm expecting, hopefully, by the end of the weekend, sometime this week, the next breakup. And then we're literally into what we've been describing as the 3, 4, 5s. The pullback should be within the 4th wave of the previous degree, which in this case is this here, which is the minute wave 4. Here is the minor wave 4, which I'm anticipating pullback. So anywhere within this range, it could be a real shallow pullback, but anything down to sort of 17,800, be looking to put the longs back on. Then you're going to have this series of 5th waves to a new high to finish off the 3rd for the intermediate level wave. That will put in its 4th and 5th, which will effectively put in the fifth of a primary wave, which will put in the top of a cycle wave. So these are all higher and higher and all part of the bull market. And we're going to be getting deep into Q2 here. Next consolidation to come back into the previous fourth wave, blah, blah, blah. And you can see how these all carry on grinding up. That will hopefully put in a wave 2 that needs updating because don't change the labels on the further out bit, but you get the point. It's grinding up 3, 4, 5s, and we're very much in this. So this can become choppy, become volatile. Every time we get a pullback, it's going to be the end of the world, doom crowd. Remember, we're expecting these things to new highs, pullback, new highs, pullback. You're ahead of the game. So here we have good old Nikkei. We had the big fat arrow saying we were going to have a little bit of a explosion up once they sorted out their rates. And so it happened. We had the gap up. It's been kind of consolidating. We've hit a third wave. So again, we're in another grinding scenario. And it very much looks like 1 for 1 isn't a million miles away back down here at 43.25. Look for that as a time to buy back in. Looking for a nice 3 or 4% upside to put in the top of a third wave. What does that mean? It means we're going to get a fourth wave down, doesn't it? 3, 4, 5 scenario, just like the other indices. And the extreme of the previous fourth wave is down here at sort of 38.5-ish. So once we're up here at 42 to 38.5, 3,500, it's a 10%er, isn't it? So we might have a little bit of stalling going on, but that might all be around commentary and the pressure put on the yen. So this does have potential to put in a proper consolidator. If they suddenly start having to defend the yen, there'll be a bit of a shock going on and the profit taking might come in. But this is, again, something that you'd want to buy into. So the clever people will be letting stock go into this final fifth wave over here to put in the intermediate 3 with a view to supporting the market back down here at a classic fourth wave extreme. That's playing out beautifully, and I think that is one of the indices to keep playing the ranges in. It's been brilliant, the Nikkei. As promised, the Footsie. Since the cycle 1, we've been putting in a 3-wave consolidator, long protracted, and it looks like we're still within that. We're in the B wave, so the middle, the second wave, and that's split into a double UXY, which itself is something. You can see all this subdivision. It's very, it's symptomatic of this. Can we break the negative psychology? Yes, we can. Oh, no, we can't. Yes, we can. But we're finally getting dragged along by world indices. You can't really fight it. We were last looking at it around here, saying we'd have this move up, consolidation, then a final equal legs again. It may go further than that, but that still suggests we've got upside from here around 7,900 up towards 8,100, 2 or 3% at least, not to be balked at. And it will be a new all-time high. So let's hope they can get that on the tape. Just to do a quick search on the equal weight S&P, I just decided to go for the Invesco ETF. It's the way that a lot of people will play it. We looked the other week when they were just about to break out here, saying there's a change in breadth happening here, and this ETF will be invested in the largest weights. You don't need to invest in every stock on an ETF to get the performance. It'll be a proxy. It might be less than half the stocks required to make it happen, but it'll be the ones that are moving. And as it is, look, we've got proper breakout here. This is for those that said that the market is tech only. This is the next shoe that will see them off. If the rally keeps on broadening, it'd be hard to fight, and the disparity between the top heavyweights and the lower ones is huge. So there's lots of scope for this, putting in proper, well-supported consolidations and just carrying on grinding higher. So expect a few more talking heads now that the meetings are out of the way. Booba monthly minutes out today. Bostic's back. Man will be available. Let's see what she's got to say, why she dialed back her rate hiking stance. Fed Governor Cook is back. Booba's bounce. He's always saying something. Rogers in Canada, Senior Deputy Governor, and Lane on Tuesday. Tamura of the Bank of Japan on Wednesday. Bank of England FPC meeting minutes come out. Fed's Waller is back. Thursday looks dull going into the holiday. And then on Friday, good old Daily never fails. And Chair Powell will be speaking 3 hours after the PCE has come out. So will he be vindicated in what he had to say at the FOMC meeting? There's always a calendar at the bottom. Just check it out. It's pretty light. We've gone through it. Good luck out there. And this is the Sith signing off.